Be ready for a rebound in earnings growth next year, and we have 3 stocks that you can invest in now to take advantage. Here to talk about that with me is Oscar Schafer of Rivulet Capital. Hi, Oscar.
How you doing?
So we've got very little earnings growth in, say, the S&P 500 right now, but you think that that's going to rebound next year? We're going to have a return to decent earnings growth.
Well, one of the reasons I think we have relatively earning, that's your words, not mine, I don't really look at the big macro that way, is that the dollar being strong makes the foreign earnings, which I think are a third of a big U.S. corporation's earnings, the translation will be a problem. But I think next year, the dollar will be lower than it is now. I think the dollar is going to go down. And as a consequence, the translation will be good. And I think that the consumer, which is the largest part of the economy, is doing very well. Everybody's talking about how bad the economy is, the recession. And the industrial section, there's some problems. But the consumer's doing very well, and he's the person who drives the economy.
So as some of those headwinds go away, you're going to see more of what has been decent earnings growth, all things considered.
Exactly, and you've got the energy space, which certainly suffered this year. You're going to anniversary low oil prices. So I think the comparisons, A, from the consumer, the dollar, and oil would be good next year, and the earnings will be surprised. I don't know how much they'll be up, but they'll be up more than most people think.
Now, at Rivulet, you own 12 to 15 stocks,
Yeah, we're a very concentrated portfolio.
Okay, and Rivulet, you were explaining a moment ago, it's a river off the main river. It's
off
ideas
the
that are off the mainstream.
It's off the mainstream, and that's the way we invest.
Okay.
Many of our investors have never heard of the companies that we own, and from our point of view, that's just as well.
Let's talk about 3, and I want to start with Interxion.
Yes.
This is a data center, and you said it was
It's a carrier neutral, meaning they don't care where the input and the output goes, but it's a carrier neutral data center in London, which kind of falls between the cracks in investing because it's in Amsterdam, it's a European data center company. U.S. analysts don't really want to follow it because it's Europe. It trades in the United States, so the European analysts don't want to follow. But the whole industry is going through consolidation. There was an acquisition of a data center company at 14 times EBITDA. If you put those same multiples on recent deals and today's deals, you get more than a 50% increase in Interxion.
Cheaper than what you would pay for this kind of business in the U.S.?
Yes. Yes, absolutely. And once again, if you're Amazon or Netflix and you want to have connections in a worldwide sense, you don't want to necessarily go with somebody that's only in Europe. So I think longer term, in the next 2 or 3 years, Interxion's got to be part of a worldwide network.
ANI Pharmaceuticals, ticker
Yes.
there, ANIP.
Right.
What's to like about this?
Well, what's to like about it is it's a company that's been tarred with the biotech brush, down from 72 to about 42, but it's not a biotech company. And if you look at the products they have now, plus the products that they've licensed from Teva, an Australian company, and most importantly, a product that they got from Merck, I think this is a company which sells in the 40s. In the next 3 or 4 years will earn over $10 a share.
You mentioned that they specialize in taking on drugs that the big major pharma companies don't want to handle anymore. A lucrative business, and is there room for growth going forward in that business?
Well, number one is, as far as the Merck product is concerned, this is a product which has been approved by the FDA, but the Merck just didn't want to play in that sandbox. So they competed against 2 or 3 bigger companies, I think, but gave Merck the back end, the royalties, once it was on the market, such that Merck could make money and not have to spend the money to get into the business. Meanwhile, with companies merging in the generic space, these big companies want to get rid of smaller companies. They don't want to have the sales force. So smaller companies like ANI can pick up these products, market them well, and do well, and buy them at fairly low prices.
And the last one, there's been a recent name change. Par Pacific Holdings, formerly Par Petroleum. What do you like about Par?
Well, 2 or 3 things I like about Par. Number one is Sam Zell, the grave dancer and the great investor, owns 30% of the company. 2, just last week, the board put in a new CEO, one of Sam Zell's right-hand men named Bill Pate. And it's got 2 or 3 things. It's got a refining business, got a distribution business, logistics business, oil and gas business, all of which, if you do some of the parts, low multiples on the refining, higher multiples on the logistics business, gets you to about the stock price 21, 22, or 23. But it has $1.4 billion NOL, 34 million shares, discounted even 35%.
A tax loss.
It's an NOL, tax loss that it can not operating loss, which it can use to fold in acquisitions. So it has very low cost of capital when you think that the pre-tax is the after-tax on any acquisition they make. So that's probably worth another $4 or $5 standing on its own. With Bill Pate, the new CEO, if he makes smart acquisitions, the stock could more than double from here.
So a company like this, investors just perhaps aren't doing the math on what the company's really worth when you put the parts together.
Yes, and there's not that much. Once again, that's one of the mid-cap stocks that's not well followed.
Thanks for sharing your picks with us, Oscar.
Thanks for having me.